All right, let's get right into it. Today, we're digging into State Street's Q3 2025 earnings call. And let me tell you, they really delivered a powerhouse quarter that turned a lot of heads. So we're going to break down the numbers and figure out what's really driving this story.
Okay, first things first, let's just look at the headline number, because wow, it really says it all. We're talking about a massive 23% jump in earnings per share year over year. That's not just a good number. No way. That's a statement. It sets a super strong tone right from the get-go.
And that huge EPS growth, well, it absolutely crushed Wall Street's expectations. I mean, look at this. They beat on both the top and the bottom lines. Their earnings per share came in at $2.78. That's almost 7% higher than what analysts were predicting. And revenue? Comfortably ahead too. This is exactly the kind of clean, no doubt about it beat that investors just love to see.
What's really wild about this isn't just the one-off beat, it's the consistency. The CEO, Ron Hanley, he really hammered this point home. This was their 7th consecutive quarter of what they call positive total operating leverage. So what does that actually mean? It's simple, really. It means their revenues are growing a lot faster than their costs. And that, right there, is a crystal clear sign of disciplined execution and some serious, sustained momentum.
So the big question is, where did all this outperformance actually come from? Well, the answer is pretty clear. It's all about their fee-generating businesses. I mean, they were just firing on all cylinders. Let's pop the hood and take a look at this engine.
Okay, so this chart gives you a really good visual breakdown of their fee income. And you can see right away, it's not just one thing driving all the growth. They've got this really diversified mix. You've got servicing fees, management fees, foreign exchange, and securities finance, plus software. It's this mix that gives them such a stable and, frankly, powerful revenue base.
And wow, this bar chart just lays it all out. Look at how strong that growth really was. We're talking management fees and FX trading, both up a staggering 16% compared to last year. And even their huge servicing fees business, that big bedrock, it put up a really solid 7% gain. These are not small numbers, folks. This is strong, broad-based, high-quality growth across the board.
Just to give you a sense of scale here, because the numbers are almost hard to wrap your head around, they hit a new record, $51.7 trillion in assets under custody or administration. Let that sink in. It's this absolutely massive growing base that's the foundation for that steady servicing fee revenue we were just talking about. All right, so the revenue story is obviously fantastic. But, a strong top line is only half the picture, right? A smart investor always looks at the other side of the equation. We're talking about costs and especially the outlook for net interest income, or NII, which frankly has been a bit of a sore spot for a while.
And here it is, that positive operating leverage we mentioned, laid out as clearly as possible. Look at this. Total revenues are up 9% year over year. Meanwhile, total expenses up only 5%. That gap, that's the magic. That's pure profitability. It really shows you that management isn't just getting lucky with a good market. They are actively and with a lot of discipline managing their costs.
And it's not just talk. The CFO, John Woods, he put a hard number on that discipline. He's saying they are firmly on track to hit their $500 million savings target for the year. That's not just some nice-sounding goal. It's tangible cost control that flows directly to the bottom line.
Okay, but let's get back to NII. Net interest income. This has been the question on every investor's mind, not just for State Street, but for all of its peers. So, is the outlook finally getting better? Well, based on what we heard on the call, it really seems like we might have finally hit a turning point.
So, management didn't just say it's getting better. They laid out a really clear 3-step case for why they expect NII to actually go up in the fourth quarter. Okay, so step 1. With rates higher now, they can reinvest their money at much better yields. That's a big plus. Step 2. Some old interest rate hedges that were hurting them are finally rolling off. That pain is just gone. And third, and this is key, they're seeing deposits start to stabilize instead of flowing out. You put those 3 things together, and you've got a really powerful tailwind for NII as we head into next year. Okay, so the present is looking strong, and the near-term outlook is definitely improving. That's great. But what about the future? What's the long-term plan here? Well, State Street actually spent a good chunk of time on the call talking about exactly that, their big initiatives for future growth.
And believe me, there's a lot going on. Their big alpha platform, it keeps winning new business. They're making a big push into wealth management with a new fintech partnership. And check this out. They're about to launch a tokenization platform for digital assets.
Oh, and on top of all that, they launched 39 new products this quarter alone. This is a company that is absolutely investing in its own future. And I think this quote from the CEO just nails their whole ambition. They're not just trying to dip their toes in the future of finance. No, they want to be the bridge, the essential connection between the traditional finance world we all know and the new digital one that's emerging. That's a really bold vision, for sure. All right, let's bring it all home. We've seen a fantastic quarter, really tight cost control, a brightening outlook for NII, and a pipeline full of innovation. So the million-dollar question is, what does all this mean for the stock from here? Well, first, just take a look at their updated guidance for the full year. They jacked up their fee revenue growth forecast pretty significantly. Now they're expecting 8.5% to 9%. When management shows that kind of confidence, especially backed by the momentum we've just seen, that's a seriously bullish signal for their core business. So after all that, after this really impressive quarter, and what sounds like a pretty optimistic outlook, what's the call on State Street? We're putting an outperform rating on the stock. Here's why. The outlook for next quarter looks solid. You've got that fee momentum continuing, and this is the big one, that expected rise in NII, which should confirm that things have finally bottomed out. The real catalyst going forward is going to be seeing them execute on that NII recovery and keep costs in check. If they do that, you're going to see even more operating leverage into 2026. Right now, it just feels like the market isn't fully appreciating how strong their fee business is, that a turn in NII is here, or just how clear their vision for the future is. And just as a final reminder, this is not financial advice.